So, as per you, what are the common conceptions that retail trader have regarding vol trading? One of them is that if there is spike in vol trading, you just sell the vol. That's a very common misconception which I've heard a lot of people talking about. So, what, as per you, it's they have wrong misconception, and instead of those, what they should focus on?
Yeah, so I would say to the first misconception, that's a great misconception, by the way. And that's a misconception that exists. It's not just in options, it's in all markets. The idea that if the price goes up, that it is expensive, and if the price goes down, it is cheap. But uh, we know just from basic understanding of investing that doesn't necessarily need to be true. If a if a stock goes up 10%, but its expected growth rate has went from 10% a year to 30% a year, I would argue that the stock is cheap, that it going up 10% in one shot is probably not enough to it's not enough of a premium to the fact that now this stock is expected to grow at 30% a year. This is the same thing with options. To say that what happens with options is when vol is on the very low end of its range, it will tend to trade expensive compared to how it's realized, because there's an assumption of mean reversion baked into the market. Volatility itself is a mean reverting property. We don't know how fast it's going to mean revert. I mean, vol can, if you take a year like 2017, the implied vol can stay, and the realized vol can stay subdued for a long period of time. And when vol goes up, it can stay elevated for a long time. And we only have to look at the GFC to see how long vol can stay elevated. So the idea that high vol is a sale and low vol is a buy ignores the fact that low vol is always coincident with the realized vol being even lower. And that's because the market is always saying, well, I know that the realized vol is 6 in the S&P, but we don't expect it to be 6 forever. So the fair IV might be 8 or 9. So if you buy that low vol of 8 or 9, a 1 month option for 8 or 9 vol, and you continue to realize 6 for the next month, they're going to lose on that option. So it's not so simple. In other words, like the market is adjusting, and vice versa. It's true on the other side. When vol gets very, very expensive because the market has started to move around a lot, the market does not just amortize that those current high vol moves and say, oh, this is now what this stock is forever, that this stock is always going to move. This is a 20 vol stock that's now moving 35 vol, and we're just going to say, you know what, a 1 year option should be 35 vol. That's never going to happen. So what happens is, if you sell, maybe that vol goes from 20 to 25. So what happens is you go and you sell this vol that looks expensive because you said, wow, vol went from 20 to 25. It's up a lot. The problem is all that period of time when the stock is realizing 35, you're losing carry. So the trade-off is always the carry versus the directional aspect. When you buy cheap vol, you're almost always losing on carry, and you're winning on actuarially on the fact that you think vol is going to go up. But the timing, the rate at which it goes up versus how long the realized stays subdued is going to determine your P&L. And the market is such that it will price options in a way that will, what I like to say, there's no easy trades. I mean, if the market, if S&P vol, when the realized got to 6, if they priced vol at 6, that would be an easy trade. Just buy 6 vol, because you're already about as low as vol can go, and you have upside directionally speaking, and you have almost no cost owning that. That would be an easy trade. The market does not just offer you easy trades like that. So for retail traders, and like this is what our tool does, is we use this cross-sectional lens to say, let's look at everything and say, we expect high vol names or high realized vol names to have a discounted vol. And we expect low realized vol names to have a vol premium to that realized. Even though the IV is low, it's still premium to the realized. We expect that already. That's not what we call an opportunity. So if you were to look at this on a chart, it looks like a diagonal line. Low vol, low realized vol, high implied vol, relatively speaking, to the realized, and vice versa. Everything that's near the diagonal line is sort of what we expect. So what's interesting is things that lie off the diagonal. So the things that are in the upper right quadrant of this sort of visual that I've painted, and things that are in the lower left quadrant, lower left quadrant being low vols that are or low realized vol but low implied vol at the same time, like as low as the realized vol itself. That's interesting. So that's our lens is very much to say, to give the market a lot of credit and say it's very smart. It knows how to price volatility. If we throw everything on a chart, you'll actually see that. But there's still some things that lie off the diagonal. And then you can look at those things and that becomes your candidates. Let's look at these names and then we can say, and then we can reason about, do these names deserve to be off the diagonal? And that's, like I said, where you bring your context to it.